Welcome back to Intelligent Investment Today, the podcast concerned with all things value investing. In each episode, we take a topic from the investment landscape and try to apply the lessons laid down by the man widely regarded as the founding father of value investing. Tutor and mentor to Warren Buffett, no less. We're of course talking about the late, great Benjamin Graham. In this episode, we're going to be tackling a thought experiment that, at first glance, sounds pretty extreme, even unrealistic, but which goes right to the heart of what Graham meant by intelligent investing. We're going to ask a simple but unsettling question. What if the stock market were to shut down for an entire year? No trading, no price quotes, no daily movements to reassure us or alarm us. Just ownership, stripped of noise. Benjamin Graham repeatedly warned investors against confusing price with value, speculation with investment, and activity with intelligence. By imagining a world in which prices temporarily disappear, we're forced to confront those distinctions head-on. What assets would still make sense to own? What businesses would continue to create value? And perhaps most importantly, how many of our current holdings rely more on market psychology than on fundamental worth? The aim of this episode isn't to predict the next crisis or market closure. It's to sharpen our understanding of what it really means to invest with a margin of safety, with patience, and with discipline, exactly as Graham intended. So let's get right down to it. As ever, sit back, tune in, and get ready to take on board another lesson in value investing, as inspired by Benjamin Graham. Imagine waking up tomorrow to a headline that feels almost impossible to process. Global stock markets are closing. Not for a day, not for a week, but for an entire year. No trading, no price quotes, no apps refreshing every few seconds, no experts debating whether today's move means something, just silence. At first, most investors would feel panic, and eventually something more unsettling. Emptiness. Because without prices, without movement, without constant feedback, investing suddenly becomes very quiet. And in that quiet, a far more important question emerges. If the market were shut down for a year, what would still be worth owning? And this isn't a fantasy for entertainment's sake. Markets have closed before. Wars, financial crises, political upheaval, and systematic failures have all forced exchanges to shut their doors, sometimes for far longer than anyone expected. Liquidity, which we tend to treat as a permanent fixture, has always been temporary. And that's why this thought experiment matters. It strips investing back to its foundations. It removes a scorecard, it removes the noise, and it forces us to confront an uncomfortable truth. Many things we believe we own are only valuable as long as someone else is willing to price them every second of the day. When prices disappear, ownership becomes very real, very quickly. Many investors believe that they are long-term thinkers. They talk about decades. They talk about compounding. They talk about patience. But their behaviour often tells a very different story. They check their portfolios daily. They react emotionally to short-term moves. They feel validated when prices rise and anxious when they fall. And the market trains us to confuse price with value. As long as prices are visible and liquid, we often mistake activity for progress. Movement feels like meaning. But when markets go quiet, speculation fades, narratives weaken, and what remains is a simple reality of what you actually own. This is where the discomfort begins. Certain assets would lose their appeal almost immediately in a long-term shutdown. Anything that depends on constant liquidity starts to feel somewhat fragile. Strategies that rely on frequent rebalancing, leverage that needs daily management, or investments whose logic only works when prices are continuously updated, all begin to unravel. Psychologically, at least. It's not that these assets stop existing, it's that they stop feeling real. There's a revealing question every investor should ask themselves in this scenario. If I couldn't sell this for 12 months, would I still feel comfortable owning it? If the answer depends on hope, timing, or someone else stepping in later, then that confidence may be borrowed, not earned. Businesses that generate no cash flow also become far less comforting when markets close. Companies built entirely on expectations, future growth stories, or the promise of eventual market dominance rely heavily on the market's willingness to constantly reprice optimism. In a closed market, stories don't compound, but cash does. That doesn't mean that growth has no value. It means that when the future stops being marked to market every day, present reality becomes far more important. Cash flow stops becoming a mere line item and becomes a lifeline. And there's another category that quietly loses its power in this environment. Investments you can't explain without pointing to a chart. If your conviction relies on recent performance, trend lines, or momentum, silence exposes how shallow that conviction really is. Understanding can survive without charts. Belief often does not. So what would still be worth owning? The answer, as you may not be surprised to hear, isn't exciting. And that is precisely the point. Assets that generate reliable cash flow retain their value whether markets are open or closed. Businesses that sell essential goods and services don't need market quotes to function. Utility companies continue to bill. Insurance premiums are still paid. Food still moves through supply chains. Employees still show up. Customers still need solutions. Cash flow is the value you can feel, not just calculate. Ownership that provides control or direct use also becomes much more meaningful when markets are silent. Land that produces income or sustenance doesn't care about sentiment. A business with loyal customers and local demand doesn't require daily validation from investors. When liquidity disappears, control matters more than optionality. Scarcity combined with real-world utility holds up as well. That is, resources tied to everyday human activity. Energy, infrastructure, essential commodities. People still heat their homes. Goods still move. Things still get built. Markets may amplify these activities, but they don't create them. But perhaps the most profound change in a year-long shutdown wouldn't be financial at all. It would be psychological. Without prices, performance anxiety fades. There are no benchmarks to chase, no peers to compare against, no constant reminder of whether you're ahead or behind. Investing becomes private again. Quiet, personal. And that quiet can be deeply uncomfortable, because now the only question that really matters is whether your decisions were intelligent or merely popular at the time you made them. Patience returns in a way most investors have never experienced. You stop reacting and you start evaluating. Many people still claim they want long-term returns, yet very few are emotionally prepared for long-term stillness. This thought experiment reveals uncomfortable truths about modern investing. Liquidity, which we often take for granted, is a luxury. Volatility, which we treat as a risk, is often just noise. And excitement, which we often mistake for opportunity, frequently masks fragility. A truly intelligent portfolio isn't designed for perfect conditions. It's designed to survive imperfect ones. It assumes delays, it assumes friction, and it accepts that exits may not always be available when we want them. That doesn't mean avoiding markets or innovation. It means respecting reality. If you were forced to hold everything you own for a year with no feedback at all, what would you feel calm about? What would continue to work quietly in the background? What would you still understand without reassurance? Those questions matter far more than any forecast. The deeper lesson here isn't about fear or pessimism. It's about perspective. Markets are extraordinary tools, but they make terrible masters. When prices dominate thinking, intelligence erodes. When ownership dominates thinking, intelligence returns. The best investments make sense even in silence. They function without applause. They create value without constant validation. They reward patience not because it's fashionable, but because it's necessary. So if the stock market were shut down for an entire year, what would still be worth owning? Not a ticker symbol, not a narrative, not a trade, but a claim on real value, on cash flow, on usefulness, on things that work whether anyone is paying attention or not. Because the ultimate test of an investment isn't how it performs when the markets are open and noisy. It's how comfortable you are owning it when they're closed and quiet. And sometimes the most intelligent investment decision you can make is learning how to think clearly when nobody is watching. And on that note, we draw this edition of Intelligent Investment Today to a close. I do hope you've enjoyed it, and that this thought experiment has reinforced a timeless lesson at the very heart of value investing. That intelligence in investing isn't measured by activity or excitement, but by discipline, understanding and patience. As Benjamin Graham reminded us, the market is there to serve us, not to instruct us. And the quieter we can think, the better our decisions tend to be. If you have found this episode worthwhile, do consider subscribing or adding it to your playlist. That way you'll be reminded whenever a new edition lands on your platform. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.